Welcome, everyone. Today, my guest is Kirk Willison, Vice President of Government and Industry Relations for ArchMI, and a mortgage veteran with more than 25 years in government relations. Kirk is also the host of PolicyCast, a podcast focused on what's happening in D.C. related to housing. And today, we'll be talking about how the industry is effectively lobbying for some changes while hitting a roadblock on others. First, here's a word from our sponsor. Hi, I'm Sarah Wheeler, Editor-in-Chief at HW Media, talking to Desmond Smith, Chief Growth Officer at UWM, about SafeCheck. Desmond, how are trigger leads impacting borrowers?
Yes. Hi, Sarah. How are you? So trigger leads have become a very big issue through many industries, not just mortgages, but specifically to mortgages. What we've seen happen is a loan officer or a broker will pull credit, and sometime within minutes, but definitely within the hour, we've had consumers receive upwards of 40 calls. Within a day or two, they may receive hundreds of calls. So that's the reason that UWM created SafeCheck to protect borrowers.
Thanks, Desmond. And listeners, you can find out more about SafeCheck at uwm.com. Kirk, welcome to the podcast.
It's great to be here, Sarah. Thank you very much for the invitation.
No, it's great to have you on. I am an avid listener of your podcast, the PolicyCast. I learn a lot from that, and I just love the way that you interview, especially people from the government. You've got your hand on the pulse of many of the things that are happening in our industry as well. So it's a pleasure for me to have you on.
It's great. It's really great to be here, and it's been a delight to try to do these podcasts over the last couple of years.
So I wanted to start out with a little bit about your background. How did you get into the industry? How did you, get to where you are now?
It probably all started. My first crack at the financial services industry was doing public relations work for the American Bankers Association. And my function there was to really advocate on the public policy side for the government affairs agenda of the ABA. And that goes back to the mid-1980s. And after that, I got hired as a lobbyist out in San Diego for a bank called Home Fed Bank. It was one of the largest savings and loans at the time. And unfortunately, so many savings and loans eventually succumbed and became a part of the Resolution Trust Corporation. And after that, I had really the good fortune of doing much the same work at Countrywide Home Loans. Worked in Countrywide's offices in California for a couple of years, and then was asked to come back to Washington and create a Washington office, government affairs office for Countrywide. Worked it all for 8 years at Countrywide, then worked over in a similar capacity on industry relations at Freddie Mac. Spent really the bulk of my time, 14 years at Freddie Mac, and eventually 3 years ago came here to Arch Mortgage Insurance as head of government industry relations at Arch.
Great resume. You have been in and around the Beltway and understand that. So this is my first question to you is, what do you think that the mortgage industry, either that's lenders, servicers, appraisers, or those in title, we have this big industry. What do you think they don't understand about Washington, D.C. and the way things work there?
Well, I think one of the things right now certainly is that the partisanship on Capitol Hill is so intense that the likelihood of getting anything through Congress that would be favorable or even unfavorable to the mortgage industry is slim and none. And I know that each time, that the Mortgage Bankers Association has its annual advocacy and a lot of fly-in take place from other trade associations, and a lot of the focus does seem to be on Congress. But my focus would be, or at least recommendation, talk to the regulators. Make sure you understand where the government banking agencies and the FHFA and HUD are coming from, because it's much more likely that housing policy is going to be set at the regulatory level as opposed to in Congress.
That is an amazing insight. I think that's so true, especially right now, to your point. How has that changed since the first time, you started working with legislators?
Well, I think back then there really was a willingness for Republicans and Democrats to work together. And also, frankly, when I first started, the Democrats had significant control of the House of Representatives and the Senate. The Senate began to flip a little bit, but and until the mid 90s, it was a dream for Republicans to ever control the House of Representatives. So it wasn't as quite contentious in trying to figure out, can you get the necessary votes to get anything through? Back in those days, it was just how do you persuade a committee to move legislation, and then the likelihood is once it passed out of committee, it was going to get to the floor and pass there too. So we've seen just this narrowing of the political gap between Republicans and Democrats. And it looks that way. It's going to be that way for some time to come now. And it's going to just make it very difficult to get things through Congress. And we're going to be looking at whoever is the administration to really set housing policy, I think, for some time to come.
It's we've definitely noticed that as well. So that, in the past we might be like, oh my gosh, this bill just got introduced. This is a housing bill. We need to talk about it. It's like, what are the chances this bill even gets out of committee? But if it does, how does it pass the other house? If it's in the Senate or the House, the chances of something getting through are so slim. Well, so I would turn the question back on you and say, what do you think those in DC don't understand about the mortgage industry?
Well, okay, so let's start again back with Congress. You're dealing, most of us, when we go up to Capitol Hill, are dealing with people who are young staffers, relatively young staffers, who have probably never been able to buy a house in the Washington, D.C. market because their salary just doesn't provide for that. Or they're pretty young and they haven't really developed, a family situation where you're going to be looking for a home ownership situation. So I think part of it is just that understanding of the process of the cost of getting into a home, the challenges that families in the so-called hinterlands face in trying to become homeowners for the first time. So I think that's certainly a challenge. A member of Congress is much more likely to understand, but sometimes getting in to visit with a member of Congress is the challenge in and of itself. So I think that is that. But I think that people do need to be reminded all the time of the value of home ownership and how that the contribution home ownership brings to a local economy in terms of construction of new homes, in terms of the durables that people buy when they become homeowners, the fact that they become much more civically engaged when they own their own home as opposed to rent. Those are things that constantly being needed to re-educate. Particularly, the average longevity of a member of Congress right now is very short. About 50% of the members of the House of Representatives have been there just a couple terms.
That's really, I would think that's a challenge that I don't even think about that often. It's just that when you have that kind of turnover, you're starting from scratch. This isn't a person who has, and they have so many issues. The housing is just one of them.
That's right. And I tell you one of the things that I've done at Arch, and we've done 3 of these just in the last 6 months or so. And we've created what we're calling affordable homeownership roundtables, where we go and meet with a member of Congress in their district. And we, for example, earlier in February, we met with Warren Davidson, the new chair of the Housing and the Insurance Subcommittee. And what we did is we brought together realtors and home builders and lenders and appraisers, and we just sat down for 90 minutes with the chairman, and we talked about housing and the challenges of affordable homeownership in his district and the barriers and potential solutions. And we replicated that in a couple of different places. We did the same with a new congresswoman from Indiana, Erin Houchin, represents actually just the other side of the river from Chairman Davidson, and then with Wiley Nickel, a new freshman Democrat from suburban Raleigh. So we think that this is an opportunity for us to really gather the entire housing ecosystem together and to share the common challenges and barriers and really get a sense of solutions for a wide variety of different interests. And the one thing that we found is that homeownership is valued whether we're a Democrat or a Republican. And the solutions to an affordable housing challenge doesn't seem to come from one party or another. And they're open to getting ideas from all comers.
I think that is sort of our secret sauce right now, right? I mean, And those members of Congress certainly have family members who are being shut out of homeownership, who have, locked in a low rate and are going to stay there forever. I mean, this is an issue they can understand on one level, just because we all have family members. We all are, have different homeownership experiences ourselves, but this is definitely bubbled to the top of the consumer conversation. So it's not just like some, out of the way conversation happening.
Exactly.
So when you think about regulators, I think one of the things that the mortgage industry can really feel is that, like, here are these people who seem, I mean, they're not the enemy at all, but like they might not understand what priorities we have. And I think especially in this particular time so you see something like, regulators really being pretty tough about the buybacks, right? About what they're looking for in loans, and seemingly they would say no, that they're just doing exactly what they've always done. But the FHFA, regulations or what they're looking for on that, so that Fannie and Freddie are being very strict about buybacks at a time when that is going to tank some mortgage companies, because there's just, from a market's perspective, there's no way to do that. Or when they are like, okay, we're rolling out this new thing, and it's like, why are you doing that now when there's so much pain in the industry? And so I would love your sense of, like, how much do regulators think about where the industry is right now from an economic standpoint?
Let's think about the LLPA changes that were made at FHFA, and let's particularly focus in on the 40% DTI situation, where FHFA initially proposed that there be higher LLPAs, loan level price adjustments, or upfront pricing for any loan that would exceed a 40% debt to income ratio. And the industry immediately pushed back against that. And it wasn't so much because they didn't recognize that higher risks existed, but it was the operational challenge. It was a situation where a borrower may perceive themselves as being below a 40% DTI when they come into the application process, and then find out at toward the end that actually the way that their debt to income has been calculated, it exceeds it, and now they're going to be faced with a different interest rate altogether. The administration actually listened. And I think that this was a combination of, again, the Mortgage Bankers Association, this time going to Congress and not asking for a legislative solution, but asking members of Congress to contact regulators and say, look at this from a different perspective. It looks like a bait and switch situation. It's an operational nightmare for the industry. And the FHFA did some recalibrating, and decided to pull back on that change. So I think that there's a situation there where the industry collectively got together and did a really good education job. Didn't shoot from the hip. They put their arguments out front, met directly with the leaders over at FHFA. And I have found, certainly during the time that Sandra Thompson has been in office, that her and her staff are very open to listening and making adjustments as needed.
I think that is a perfect example of how to get something done. To your point, like, it was very strategic, and they had to act in a very quick amount of time. I mean, in order to stop that from going into effect as soon as possible, this was not they didn't have a long time to strategize.
No, they didn't, and they really got their ducks in a row very quickly. And now, just in this past week, we've seen the proposal out of the banking regulators when it comes to higher bank capital levels, the so-called Basel III endgame that was just proposed. And as it turns out, the nation's largest banks, about the nation's top 30 banks, are going to be faced with significantly higher capital standards for residential mortgages. So I think that we are about to see a redux of the situation that we just saw with the LLPAs, that the banking industry, this time is a little broader than just the MBA, is going to be articulating a need to say, wait a minute, are these changes really necessary? I mean, what we're seeing is on some of the higher risk loans or the higher LTV loans, that it could double the amount of capital that banks currently have to set aside for those type of loans. And that is going to have really negative ramifications for the more affordable, that the minority, the lower income levels of borrowers. Actually, and ironically, this administration has been very active in trying to grow home ownership.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to HousingWire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
I agree with you. I also think that, when we first looked at that, Basel III changes, when it was rumored, like, here's what might be coming out, we thought, well, maybe that's going to be good for IMBs, not good for big banks, but it's not. It's actually, it could be bad for everyone.
Well, I mean, it could be good for IMBs. I mean, if it forces banks out of the business altogether, then the remaining IMBs are going to be taking the lion's share of mortgages. But is it really good for the country to begin to see a limited number of people who are kept out of housing? For example, the banks that are participating have created their own special purpose credit programs. They're likely to portfolio those loans, and if those loans become too expensive for them to portfolio, they'll decide to get out of mortgages and focus their efforts in other arenas of assets. Now, on the other hand, at Arch and with a number of other companies in the insurance and the reinsurance business, we think it's a really strong opportunity for bank regulators to give serious consideration to giving banks capital relief for actually transferring some of their credit risk, whether it be residential mortgages or whether it be credit cards or autos or whatever. Much in the same way that the GSEs have been very successful in reducing their own risk by transferring credit risk to private investors.
What do you think the odds of that? Is there a receptive audience for that? Where are we in that process?
We've had a number of meetings with the OCC, with the Federal Reserve, and with the FDIC about the concept. Granted, we started probably very, very late in the process and didn't get anything in the original Basel III, no language that would permit it. There's a couple of hoops that need to be hurdled for this, and one of the barriers is we are very interested in offering a reinsurance option, just like, again, the GSEs. When a GSE is looking to transfer credit risk, they have two ways of doing it. They can go to the capital markets, and what they do is a CAS or the stacker proposals at Fannie and Freddie, respectively. But they also have reinsurance options. As it stands now, an insurance company isn't considered an eligible guarantor for a bank. Some language needs to be changed for that. But we do believe that there is support on Capitol Hill. We think that there is support among the constituencies in the affordable housing arena that would say, hey, if this is an option for banks to lay off credit risk and still be participants in the affordable home ownership focus of loans, that we may be able to gain some traction. But it's going to be a hard lobbying effort, but we're expecting that we're going to be up to the challenge of it.
It's such an interesting balancing act, right? So anytime you want to expand home ownership, you do have more credit risk potentially, right? Because if those people were in their normal credit box, they could already, be accessing that. So anytime you do that, but as you said, this administration has had a huge focus on affordable housing, and I feel like because of the market situation, we have more lenders interested in affordable housing, right? And reaching those borrowers that maybe they weren't that interested in when you have, a refi boom and you're up to your ears in loans you can do. So I think it's a confluence right now.
I think you're absolutely right. I mean, this is where the business is moving. And the fact that the growth in home ownership is largely going to be the minority community. Latino, African American, Asian Americans are going to have the majority of the loans of the next decade. So it makes just perfect sense for lenders, both banks and IMBs, to really start looking very closely at how they market, what kind of products and services they can offer, what kind of education they can offer to expand home ownership opportunities. And the same is true for mortgage insurance companies, for that.
I think one of the things that the industry felt when, especially with Basel III and just in general, like the DTI conversation, is that like there's less risk now. There are so many things that you just can't do now. We're not relitigating 2008. Those loans just aren't even possible at this point. So with less risk, why would now be the time to introduce some of these things?
I think that's a very good question, and all the analysts that I've been reading, particularly about the changes in the Basel, are perplexed, and to essentially make the U.S. banks have twice as much capital for residential mortgages that their international peers are faced with doesn't seem to make much sense. And reading between the lines, it sounds like there could be enough opposition that some of that might be rolled back a little ways. But again, it's going to be a tough case. You're going to have a lot of outreach to the regulators from not only the industry, but housing, consumer advocates as well, all working together to make the case that these has serious ramifications for the future home ownership opportunities for people in the very near future.
Our lead analyst, Logan Motoshami, points to the bank failures as one of the, things that happened. One of the surprise things that happened this year economically. That, nobody saw that coming necessarily. It was a surprise, and the ramifications of that in the eyes of regulators and what they need to do. Right? What do you think that looks like?
Well, I mean, I clearly, Logan's right. I mean, it was a surprise. It was also just, it was a failure of management in this case to mismanage their liabilities and their assets. It was a failure of the regulatory agencies to really not have a closer look at these. I think this is still more anecdotal than it is systemic. Most banks aren't doing that, and I think the shockwave since that time has resulted in banks doing a better job of trying to make sure that they match up their ALCO situations, as well as begin to say maybe we shouldn't have quite as much uninsured deposits as we had in the past too. So sometimes these things are healthy. And they show that the capitalist system can work. You can get a failure or two, and it can help straighten out the market.
When you look at, we talked about the short tenure of some people in Congress, right? We're coming up on an election year. It's amazing that those things happen so fast, seemingly. How do you gear up for it could be a completely different change. I was the magazine editor at HousingWire when the Trump election happened, when he won that election, and we had a whole no one knew who was going to win, but it was kind of a shock. And so we had a whole thing, and then we're like, okay, regulatory wise, because we had a looking forward, it was at the end of the year, looking forward magazine. Here's what to expect from a regulation perspective. We're like, okay, scrap that, start over. And really that's what the industry had to do with that, because you had an administration come in that really had different priorities. You could feel some whiplash again when the Biden administration came in. Every administration has their own priorities. How do you prepare for that looking forward, even this close?
Truly, when it comes to the administration, it's a huge challenge. There even had been, if you look back, there had been a little comfort for those of us in the housing industry, because organizations like the FHFA and the CFPB had directors in place for a 5-year period of time, and it didn't necessarily align with a new administration coming in. Now, thanks to a couple court cases, both of those positions are purely political now. And we saw what happened when the Supreme Court decided that the FHFA director served at the pleasure of the president and could be removed from job at will. That very day, Mark Calabria was told that he would not be staying in that job, and Sandra Thompson was appointed very soon after as acting director, and then eventually was nominated and affirmed by the Senate to be the director. So we could have, again, wholesale changes when it comes to housing policy. The one thing I will say is this, is toward the end of the Trump administration, in fact, in the very last week of the Trump administration, it produced its kind of a long-awaited report called Eliminating Regulatory Barriers for Affordable Housing, in which case it advocated many of the same things that 6 months later or so the Biden administration included in its own housing supply action plan. So there is, at least when it comes to growing the housing stock, there is some agreement. I think the around the edges is where you get when it comes to fair lending, when it comes to the push for equitable housing. I think that's where there's definitely some differences between political parties. And in fact, following the Supreme Court decision on affirmative action, I was told that there will be legislation introduced, at least in the Senate, perhaps in the House as well, that would essentially target the equitable housing finance plans that the GSEs have come out with, which were designed to grow minority home ownership, suggesting that is a wrong tactic for anything that is part of the federal government.
Wow, that is that could be significant right there, because one of the things I think of is like, any change in DC takes a little bit of time. And one of the things you have is, you have the FHFA being the regulator of Fannie and Freddie, but Fannie and Freddie are stalwarts. They've been around for a long time. You have people in those leadership positions and also stay there for their whole career, as you know. And, and in some ways they stand as a sort of a barrier against like whiplash, because it's like, it takes time to implement even things that they have to do. There is a timeline there that can be helpful for industry trying to, adjust to quick changes.
Absolutely. It's kind of like steering the Titanic. It's a very slow process, even if the change eventually gets there. And we've actually seen that, even with the equitable housing finance plans and the duty to serve plans that have come out. And it's taken them a couple cracks. They initially introduced their equitable housing finance plans for 3 years and then amended them. The most recent duty to serve plans took a little longer than usual because their first submission to Director Thompson, she kind of rejected them and sent them back and told them to make them a little more robust. So yes, it does take a little while. But again, if a new administration does come in and it takes a very hard line compared to the progressive proposals that we've seen from the Biden administration, it could certainly hasten some of the changes that we've seen, and the special purpose credit programs may have to be withdrawn a little sooner than what one would expect. But it will certainly impact the lenders down the line, who are basing a lot of their programs, a lot of their outreach based on what they're hearing from the GSEs.
I mean, this is one of the things, if you're a lender and you're trying to project out 5 years even, you're like, there's going to be an election in the middle of this that could change some of these priorities and really change some of the supports that you currently have.
It really is. And I mean, I won't speak necessarily on behalf of any particular trade association, but I will say that it is important for lenders to stay engaged, and that would include, whether it's the American Bankers Association or the Independent Community Bankers or the Mortgage Bankers Association or the Housing Policy Council. All these organizations do a really good job of keeping members informed and then trying to put together their best minds to make sure that they advocate on a policy basis. And Well, one of the things that I've tried to do at Arch is certainly educate our own employees, but through the capital commentary and the policy cast, is to really take that a step further and really educate the mortgage professionals out there about some of the risks that they're likely to face in the near future. Because I've just felt that an educated mortgage professional base makes the entire industry stronger and better and more able to adapt to change than might otherwise be the case.
Kirk, you're doing a great job with that. Thanks so much for being on. It's been a great conversation, and we will have you back again soon.
Sarah, it's been great to see you. Thank you very much. It's been a fun visit.